Shibani Sircar Kurian also joins us on the show. Shibani, hi. Thank you so much for making time and speaking with us. Your take on the market, it was looking like we are getting out of the range. Now, the earnings season is just, starting with in a couple of days with TCS itself. What's your sense of where the markets will be, let's say, in the next 2 to 3 months? Any sense?
Yeah, hi, good afternoon. So our belief has been that markets will likely remain volatile at least in the near term, with range-bound movement in the market. Now, globally, what clearly market is looking at is the inflation trajectory, and for our domestic markets, the key factor that will drive market performance will be the earnings season and the earnings trajectory. Now, when you look at Indian markets from a valuation perspective, Indian markets have clearly corrected, and that has resulted in valuations on an absolute basis moving back to long term average multiples. And even relative valuations of India relative to the emerging market pack has now come down closer to the long term average level. So, valuations have become far more attractive. However, they are not still in a range, which means that markets will see significant up move. And given the fact that globally macro uncertainties remain, we do believe that markets will see some degree of volatility in the near term. Now, in terms of earnings, what we believe is that in this quarter and for the year as a whole, which is FY24, you will see dispersion in terms of earnings at a sector level as well at a stock level. So FY24 will continue to be a year where you have to be pretty much stock specific in nature, focus on companies where there is earnings visibility and where valuations are on your side. Overall, the way we look at markets and sectors, the domestic facing companies and sectors continue to be better placed. So, banks, industrials, automobiles, cement, these are some of the segments where we continue to remain positive as compared to the global cyclicals.
Talking point, of course, is going to be the IT numbers, which are going to start trickling in. Anisha, what's the large anticipated, considering traditionally Q4 is a muted quarter?
That's exactly what Street is expecting. Seasonally weak, plus the fact that the growth rates are expected to taper. That's going to be the color of IT earnings in the quarter gone by. And when you look at the constant currency growth, it's expected to be largely flat. There are a couple of companies, the likes of HCL as well as Tech Mahindra, which are likely to actually report a decline on a sequential basis. But other than that, TCS is the one which will start the earnings season and perhaps would be the leader of the pack when it comes to the revenue growth as well. The margin estimates are actually a tad bit better. Largely, the Street is expecting a 20 to 50 basis point improvement across the board for all the companies on a sequential basis. FY24 guidance will be key to watch, and that's why Street is expecting for emphasis. Of course, the double-digit growth is out of the way, so they're expecting that perhaps a growth of 5 to 8% is what they'll pencil in, and the margin of 21 to 23% for emphasis in FY24. For HCL Tech, the growth could be 6 to 8% in constant currency in FY24, and the EBIT margin will likely be in the 18 to 20% range. And Wipro specifically for Q1 FY24 might guide for a decline of 1% to a growth of 1% kind of range. So we'll watch out for that. Just that in terms of the valuations, they have become a lot more comfortable. So if you compare the 5-year averages for the likes of TCS and Infosys, the stocks currently are trading below that mark. So there is that bit of upside available, and that's why perhaps these stocks are going a little bit stronger into the earnings. IT sector today holding up with a gain of around 1.5%. But IT is no comparison to the kind of gains that we are seeing in the realty sector today. That's up almost 4%, and the commentary, of course, across the board has been quite solid. Let's go across to Vamakshi to understand how does the sector dynamic pan out at this point of time. Vamakshi, take it away.
Well, absolutely. It has turned out to be a record year for real estate players. Let's first start off with Macrotech developers. Now, the company has reported pre-sales in FY23, and in fact, they've surpassed their guidance of around 11,500 crores. In fact, it is also happens to be the third consecutive quarter where the company has clocked in pre-sales of over 3,000 crores. Now, as far as Godrej Properties is concerned, their annual booking is nearly 22% ahead of their full year guidance. In fact, they're targeting pre-sales of nearly 20,000 crores by FY26. As far as Sobha is concerned, they forayed into the Hyderabad real estate market in the fourth quarter, and in the fourth quarter itself, their average price realization has also seen an improvement of nearly 20% year on year. Ajmera Realty is also in focus as the company has aims to double its launch pipeline in FY24 given the good momentum that they're seeing in sales, and in fact, they're targeting 2,000 crores of gross sales. So overall, a strong operational update so far, but it is also interesting to note that developers have managed to sustain pre-sales in the last 6 6 quarters. Now, as per a recent report by Avendus Spark, aggregate pre-sales have reached between 10,000 to around 12,000 crores for companies within their coverage. But at the same time, in the last 6 months, realty stocks have definitely taken a beating, with stocks such as Sobha as well as India Bulls declining by over 20%. Other counters like Phoenix Mills, Macrotech Developers as well as Prestige Real Estate is also seen under pressure. Apart from that, this fall has, when we look at it, this fall has in turn led to valuations falling below or staying at par with the 2-year average. But going ahead, we're seeing a lot of tailwinds for the sector. Repo rate has remained unchanged, which is a welcome respite to home buyers. Q1 2023 end housing inventory is down to 20 months from 42 months that was seen in 2018 as per ANROC, and this in fact is the lowest inventory overhang in the last 5 years. Luxury home sales are also seen boosting revenue, and this segment particularly is seen performing well as well. Apart from that, rising rentals are also expected to incentivize home purchases. So going ahead, the going seems really strong for most real estate players.
Keeps us strong, or rather seems strong, and the stocks as well are going good in today's trading session. I mean, be it a DLF, be it a Godrej Properties, be it a Sobha, the entire pack is holding a buzz. Oberoi Realty is also seeing a decent move in trade, holding up 1.25% right now. Shibani, just wanted to get your sense in this high inflationary environment. What's the take that you have on realty and how the sector should be looked at?
Yeah, so real estate is a sector where we have been positive on, and what we've seen over the last couple of years is that with improvement in terms of affordability, demand momentum has sustained, and that's showing through in terms of numbers. Specifically, the premium segment has seen improvement in terms of demand. Overall, as you were just discussing, one key factor that has been positive for the sector has been the decline in terms of inventory, and demand supply dynamics have now moved in terms of a favorable situation. Also, from a policy perspective, what we have seen is that various policy changes has resulted in shift towards of market share towards the larger organized players, and that is also reflected in terms of the listed space in the real estate sector. However, from here on, one key factor that we need to note is that interest rates and home loan rates have gone up quite sharply. Of course, the recent pause is something that is favorable, and we'll have to see how the monetary policy and interest rate environment moves going forward. So that's one thing that we will watch out for in terms of the overall demand in the real estate space. But as of now, given the fact that inventory levels are fairly low, demand supply dynamics are in your favor, and affordability still remains fairly favorable, our view on real estate continues to remain positive. We will also have to take a view on individual stock basis given valuations. However, the overall sector continues to be well placed at this point in time.
Okay, so the sector is well placed, but stock specific speaking, Naresh, would you be a buyer in any of the real estate names?
So would be waiting out for a little bit of a dip, because in the last 2 sessions, a lot of these stocks are up between 8 to 10%. So the risk reward becomes a little difficult, but the price action is very positive across the board. So whether it's a DLF, which looks the most promising one, or something like a Godrej property, which is bouncing after falling 50-60%. So there are multiple choices here, but I would wait for a little bit of a fade off over the next couple of sessions. Say, for example, a DLF comes down to 390, that would be 390.94. That would be a zone I would be looking to watch out for. 1130 to 1150 for Godrej properties. So overall, positive on the sector. Expect some bit of a pause, and then it could create an opportunity. If it takes a runaway move from here, would have to let it pass, because the risk reward is not that great at current levels.
Okay, so the risk reward is not that great, but since we're also talking about IT expectations and how that sector is poised, Kunal, your take as far as how one should approach the IT pack ahead of the earnings season? Is there more possibility of buying on news when the earnings surprise, or sell on the rally?
So I would believe that the action would be very, very specific towards certain stocks. So for example, the likes of Infosys has underperformed. KPIT Tech, of course, has been going through a sharp selling in the last 1 or 2 weeks. But then there are many recovery candidates which have done reasonably well. Coforge has done quite well from the mid-cap IT space. Tech Mahindra is holding on to that 1100 mark. TCS has seen a good recovery. So the action is a lot more mixed into the IT pack. So it's going to be very difficult to try and take a sector call basis on the expectation of results going forward, because the way in which stocks are going into the result season is quite divergent from the sector as well as the larger cap peers. I would bet on few large cap names. For example, Tech Mahindra is something which I've been bullish on, and I still believe that 1100 mark, it looks very attractive at the zone. Redington is something which again I've been very bullish on. I think closer to the 200 moving average around this 160 162 mark is where we flagged off a buy on the stock. So we would look to accumulate the stock in case if it dips back to those levels. So few candidates from the IT pack, just based on the individual chart patterns, nothing major or nothing critical happening in terms of the sectors.
One word on each on TCS and Infosys ahead of earnings. Any trade? Buy, sell?
No trade.
No trade whatsoever.
And a smidge of recovery actually from where we flattened out. So we're back at that 17,650 plus levels, but definitely not close to the day's highs. There's Godrej Properties, DLF, PFC, REC, those are the stocks which are holding out, as is Tata Motors and ONGC, which are really aiding up and holding out very well. In fact, on the subject of Tata Motors, as the earnings season kicks off, they've shared their updates for the JLR business. In fact, sales have risen in the fourth quarter on the back of improving semiconductor supply constraints. So let me take it across to Sharad and find out what else they have to entail on with regards to their Q4.
Well, yes, in focus we are having Tata Motors, as an important update has come from JLR, where the sales for the fourth quarter has increased, and this is also coming in as the chip supply has improved and recovered as well. Now looking at the numbers, the retail sales is up 13% on a year-on-year basis, and when it comes to the order book number, that comes in strong at almost 2 lakh units. However, this is 15,000 slow as compared to the December quarter. Now of course the free cash flow statement, that is expected to be almost 800 million pounds positive. This is for the fourth quarter, and for the whole entire year itself is expected to be around $500 million. It's kind of a thumbs up coming in from the brokerages, as we expect. BofA on Tata Motors, they have given a maintained buy rating with a target price of 475 rupees per share, and they've stated two important things. The first one being, of course, the volume and the free cash flow growth that has been beat, and that has actually beat the overall estimates by the analyst community, and they're expecting that there would be an accelerated deleveraging happening across the board. And apart from this, there's a solid ramp up of the JLR brand expected, and the amount of booking run rate is expected to be better than what the street is estimating. Apart from this, even Goldman Sachs has upgraded the stock to buy from the neutral segment, and the target price is set at 550 rupees per share. And looking at the valuations, the stock is trading at almost 7.4 times its P on its FY25 estimates, and they are expecting that there would be an improved volume outlook going ahead for JLR. And do remember, JLR contributes almost 70% of the total Tata Motors top line. Now looking at the EBITDA numbers, they are expected to be lifted, coming in by almost 15% growth for FY24, and for FY25 is expected to come in more than 16%. And lastly, Goldman Sachs stated that the market is still underestimating JLR's EBIT margin potential going ahead. So overall, we can say a strong thumbs up coming in by the brokerage community.
Okay, so the key takeaway for me was the fact that the cash conversion or generation has been almost twice than what the company had indicated at the start of the quarter itself. And of course, the volume figures are also quite enthusing. And while Goldman Sachs has upgraded Tata Motors, they've actually downgraded Maruti. So is that the trade? Naresh, your take, Maruti is Tata Motors, which is likely to outperform, and what's the trade in the auto sector?
So it could very well be both of them perform, but Maruti is something which I don't expect to underperform in a big way. Technically, the stock has been making a good base around that 8,000 to 8,200 mark. The longer term trend is that the stock has gone nowhere from those highs in 2017-18, where it topped out 9,500, 10,000. Very recently also it came to 9,500 odd levels. In the near term, I expect a move towards 9,000 for the stock. 8,300 would be a stop loss which I would keep. So short-term positive on Maruti, but Tata Motors is a much longer-term breakout in the making because it went through a good enough consolidation of 1.5 year after that big move towards 530. And today's price action is also with good volumes, could certainly be a start of a new trend for the stock, wherein it could slowly and steadily go towards 530 and 650. Now would keep a revised stop loss at 425 and look to buy the dips on Tata Motors.
What do you do with the realty names? Because, DLF has been a favorite, but look at the move that you're seeing on a Godrej today, for instance, or for that matter, the non-F&O names as well. It's pretty much a secular move across the sector.
Yeah, so I think the sector is getting a lot of confidence today with the moves, with the likes of DLF. I think Godrej Properties, Oberoi Realty also did quite well last week. So I think it's more of a sector move which is getting a lot more confident, and that's why you're seeing the non-F&O stocks or the high beta pocket from the high beta sector. High beta stocks within the high beta sector, seeing a lot more price action for themselves. But then, once this phase of initial euphoria sort of settles out, it's the stronger candidates which would tend to outperform. And my bet would still be on the likes of DLF, from current levels, from the F&O listed stocks, on the real estate pack, and Anantraj Industries on the non-F&O stock. I think both of these stocks have shown some very strong classical breakouts for themselves. So most of the other names like Oberoi Realty, Godrej Properties, these stocks are going to a recovery phase, whereas the likes of DLF as well as Anantraj, they've already confirmed breakouts on higher time frame charts. So I think that's where the leadership would probably continue to sustain. So I would be bullish on both of these stocks.
Okay, separately, Shibani, in your opening comments, you talked about how you're positive on the capital goods space, but the likes of L&T as well as Siemens are sitting at record high level as we speak. L&T above that 2300 mark. Is valuation a concern at all, or there are select names which are still attractive?
So we are mindful of valuations in the capital goods space. But however, if you look at as a theme, the entire infrastructure, manufacturing, capital goods theme continues to remain intact. The order momentum that we have seen has been extremely healthy, and we've seen large ticket orders coming through for some specific companies. So overall, we believe that the overall order growth in the next year, led by infrastructure spend, by defense, as well as some of the short cycle industrial orders that we have been seeing in the past, will likely continue. So far, when you look at the entire space, a lot of the growth has been driven by public capex, focusing specifically on roads, railways, and defense. And incrementally, we hope to see that over the next 12 to 18-month period, some signs of private sector capex also coming back. The overall balance sheets of the companies within this space continue to remain strong, and that is something that is a positive. And therefore, this is a theme that we continue to play across our portfolios. We are also seeing investments in new sectors such as renewables, green hydrogen, defense, which is again a large opportunity. And all of this is attracting investments. And therefore, growth is likely to remain fairly strong. Of course, we are mindful of valuations, as you correctly pointed out, but we do believe that the opportunity set remains intact.
Shibani, aside of the sectors that we've talked about, which are the other sectors which you at Kotak are bullish on right now?
Yeah, so some of the sectors that we continue to be positive on, firstly, the financial space. Here we believe that there has been significant improvement in terms of the underlying profitability and return ratios, especially where the larger private sector banks are concerned. However, valuations don't seem to reflect so. And in fact, if you look at for the banking space as a whole, valuations are now below long-term average multiples. Now, there is a lot of debate that is going on in terms of whether margins will start contracting or not. We do believe that there is still some leg up in terms of net interest margins moving up quarter on quarter, though of course the pace of margin improvement will start to slow down. However, despite that, we believe that the sector in terms of earnings remains fairly strong going into FY24. And in this space, we are looking at banks which have a strong retail liability franchise, which will be the key differentiator. So that's one segment where we are positive on. The second space is the auto space. Again, we have seen numbers coming through in terms of growth, both in terms of passenger vehicles, CV, as well as two-wheelers now also at the margin starting to show improvement on growth. With commodity costs having coming down, margins are also likely to show an up move, and therefore this is also a segment where we are positive on. So overall, in the domestic space, financials, industrials, auto, these are some of the segments where, as sectors, we are positive across our portfolios.
Shibani, great to have you on the show. We'll let you go on that note. Thanks as always for joining in.